Let's dive right into this explainer. We're going to combine fund types, measurement focus, and statement implications because honestly, the CPA exam always tests these concepts together. Now, this builds directly on our previous explainer about government-wide versus fund financial statements, so we're assuming you're already totally comfortable with that big picture distinction. Our main goal today, getting you exam ready. The BAR section demands absolute precision. You can't just rely on your intuition here, you have to rely on rigid accounting rules to master the exact triggers that dictate how every single dollar is reported.
We have a seriously dense blueprint to get through. We're covering the fund classification framework, governmental funds and their short-term focus, proprietary funds and business-like accounting, fiduciary funds handling custodial resources, a practical application with the city of Riverton, and we'll wrap up with exam traps and core rules.
Section 1. The Fund Classification Framework.
Classification is always the first step, and it determines all of your accounting treatment. It's literally the ultimate domino in state and local government accounting. If you get step 1 and step 2 correct, meaning you figure out whether a resource belongs to the government or someone else, and whether it's funded by taxes or fees, the rest follows automatically. Asking who owns the resources is your primary fork in the road. And why does that fork matter so much? Because going down the wrong path means you'll apply the wrong measurement focus, which leads straight to mapping the wrong financial statements. And on the exam, mapping to the wrong financial statements guarantees a failed simulation.
Moving to Section 2. Governmental Funds, Short-Term Focus.
Governmental funds are built entirely around tax-supported core services. We're talking police, fire departments, general administration. Now, the absolutely crucial thing to remember here is the strict revenue rule. Under the modified accrual basis of accounting, the measurement focus is strictly on current financial resources. Revenues are only recognized when they are both measurable and available. For the bar exam, you have to define available rigorously. It means collected within the current period or soon enough after, which is typically 60 days, to be used to pay liabilities of the current period. The government just needs to know, do we have the cash on hand right now?
Identifying the correct governmental fund type is tested all the time, so you need rapid-fire decision logic for the 5 funds. The general fund is your default bucket. Got a legally restricted tax? That's the special revenue fund. Building a new school? That triggers the capital projects fund. Paying off bond principal? Debt service. Candidates frequently mess up the nuance between the final two, so listen closely. If the government can spend the principal, it's a special revenue fund. But if the principal is legally locked up and only the earnings can be spent for public benefit, that is a permanent fund. Memorize those triggers.
Let me state this explicitly, because examiners absolutely love to test this. Governmental fund statements will never show capital assets or long-term liabilities. Never. They contain only current financial resources. When you sit for the BAR, you need to know the exact names of these statements. If you're looking at a governmental fund balance sheet or the statement of revenues, expenditures, and changes in fund balance, and one of your multiple choice options is a 30-year bond or a depreciating building, cross it out immediately. Those are distractors specifically designed to catch unprepared candidates.
Section 3. Proprietary Funds, Business-Like Accounting. When the government starts acting like a business and relying on user fees, we shift gears over to proprietary funds. These are fee-based, self-sustaining operations, and you have 2 types to master. Enterprise funds serve the general public. Think of a city water utility charging residents. Internal service funds, on the other hand, operate on a cost reimbursement basis by charging other government departments. A classic example is the general fund paying a centralized municipal IT department. Both of these funds aim to break even or generate a return, exactly like a private sector corporation.
And this brings us to a brilliant core contrast. Unlike governmental funds, proprietary funds use the economic resources measurement focus alongside full accrual accounting. Because they track long-term value, proprietary funds will record depreciation expense, and they will carry their own long-term debt on their specific statement of net position. When you're working with proprietary funds on the exam, you're applying the exact same accounting principles you'd use for a private commercial business. The full long-term economic position is completely visible here.
Section 4. Fiduciary Funds, Custodial Resources.
Our final category is fiduciary funds, where ownership is your primary decision rule. The resources here belong to others. The government is acting merely as a trustee or a custodian. There are 4 types you need to know: pension trust, investment trust, private purpose trust, which would be something like a scholarship fund exclusively for local high school students, and custodial funds. Now, here's a critical exam tip. Always use the current term, custodial funds. Never use the outdated term, agency funds.
Because these assets belong to third parties, they cannot be used for the government's own programs. Therefore, they are completely excluded from the government-wide statement of net position.
Let's move to Section 5, Application with the City of Riverton. We're going to test this framework under simulated exam conditions.
All right, put your CPA exam hats on. You're given a simulation for the fictional city of Riverton. First scenario, the city collects $250,000 in general property taxes. Stop and think for a second. Where does this go and what rules apply?
Let's walk through the thought process. Ownership, it belongs to the government. Source, taxes. Therefore, it's governmental, specifically the general fund. And because it's governmental, we use modified accrual. Unlike a proprietary fund that might record something to support a long-term economic gain, this transaction solely increases current financial resources. The statement impact is a direct hit to the statement of revenues, expenditures, and changes in fund balance, as an increase to fund balance. Absolutely no long-term assets are recorded.
Okay, scenario 2. Riverton collects $150,000 in public transit revenue from daily bus riders. Run that through your mental framework.
The trigger here is user fees charged to external customers, which firmly places this in an enterprise fund. Because it's proprietary, we use full accrual accounting and the economic resources measurement focus. In direct contrast to the property tax example, which focused only on current resources, this transit revenue supports the long-term self-sufficient operation of the transit system. For the financials, this increases the net position directly on the proprietary fund's statement of revenues, expenses, and changes in fund net position.
Final scenario. Riverton deducts $400,000 from employee paychecks for pension contributions. Who actually owns this money?
Well, the government is just holding the bag. It's the employee's money. So ownership dictates this is a fiduciary fund, specifically a pension trust fund. While it does use full accrual accounting, here's the contrast sentence you absolutely must remember for the exam. Because these assets cannot be deployed to pave roads or pay police officers, they're completely excluded from the government-wide financials to avoid overstating the government's true economic resources.
Let's run through a few more quick mini examples to really build that muscle memory. Payroll taxes withheld for the federal government, that's custodial, because it's a temporary holding for a third party. A water utility charging residents, enterprise, because it's a fee charged to the public. A general sales tax, general fund, since it's the default tax bucket. And what about a state grant strictly restricted for funding a specific after-school program? That's your special revenue fund, due to that legal restriction.
Section 6, Exam Traps and Core Rules. Let's highlight the specific traps that catch candidates off guard. Remember, the Capital Projects Fund tracks the spendable financial resources to build the asset, but it does not record the asset itself. When you're building a bridge in a Capital Projects Fund, you don't debit fixed asset, you debit capital outlay expenditure. Similarly, the Debt Service Fund tracks the cash accumulating to pay the debt, not the actual liability. When issuing a bond, you don't credit bonds payable, you credit other financing sources, bond proceeds. Do not let the examiners trick you into selecting standard corporate journal entries when you are operating inside a governmental fund.
I want you to write this memory rule down right now. I'll say it slowly and I'll say it twice. Governmental funds track short-term, spendable resources, not long-term value. Let's hear it again. Governmental funds track short-term, spendable resources, not long-term value. Burn that into your brain for exam day. If you identify ownership and funding source correctly, you have already solved most CPA exam questions on this topic. Everything else just cascades from those two variables. Review these triggers and trust the framework. But here is the ultimate provocative question you need to ask yourself as you continue your studies. When year-end finally comes, how exactly do we reconcile all these short-term, modified accrual governmental funds into the long-term, full accrual government-wide statements? Answering that is your next critical step in mastering the BAR. Keep studying, and you've got this.